Welcome back. You're still watching London Eye. I've been in conversation with the fund manager, emerging market equities at Aviva, Bryony Deuchars. Do you sense that when you speak to some of your end investors that they're still cautious about improving their or increasing their weightage towards EMs, given that they might have been stung badly in the past?
I think there is an element of caution, and positioning shows that. But I think given the performance that the market saw last year, we're up in excess of 30%, that suggests that there are flows coming into emerging markets. People are now warming to them.
Of the two you mentioned, Turkey and Argentina, which do you worry more about? Because sometimes in EMs, while the overall story is strong, you just need one accident to derail the story for a while. Do you worry that Turkey or Argentina could have the potential of doing something like that?
Turkey is most definitely a concern, and obviously we've had Erdogan in London this week, and you've seen the currency depreciate again on the back of his comments. I think we need to wait and see what happens in the elections. 24th of next month is not so far away. One has to question the independence of the central bank and what they need to do to shore up the currency. The feedback loop that has into inflation. Inflation is still already very high. Real rates are just about positive, but that could quickly be undone with the inflation that comes through on the back of the depreciation that we've seen in the lira so far this year. However, the fundamentals, again, you look at Turkey as a market, it's got that demographic dividend. It looks fundamentally very good. Unfortunately, it has structural imbalances, large proportion of FX debt, 70% of which sits with the corporates. It's uncomfortable, and it's very easy to explain why the currency in the market has done what it's done this year.
Overall, do you think emerging markets will deal okay with the shrinking liquidity in the world? It's a well-advertised fact. So do you think the reset has happened already in terms of a psychological shift, or do you think that will be a headwind that will be difficult to swim against?
Are you referring to the fact that we've got a strengthening dollar potentially?
Central bank tightening.
Central bank tightening. Arguably, yes, but the US has been tightening for some time now, and actually the dollar has been relatively weak against that. You've got a fair amount of fiscal stimulus coming through in the US, which obviously offsets some of that tightening. We are seeing central banks in the emerging markets follow suit. Some of them are forced to. We're pegged to the dollar, for example. But growth is strong. I mean, ultimately, what matters for emerging markets, it's global trade. Global trade has been strong, stronger than expected, and it's still held up well into the beginning of this year. Similarly, commodity prices, extremely important for emerging markets, and they've been exceptionally strong. Oil's up 22% this year already, and obviously there have been other issues amongst the commodity complex. Aluminium is a case in point, but all of which is quite good for emerging markets. And US growth sucking in imports, again, you can see the underpin for emerging markets. So you can make the argument that they can buck the trend this year against tighter global liquidity.
Do you worry about trade wars, or do you think there's more hype than reality? Or could it have the potential to derail the EM story?
I think you have to be cognizant of the issue of trade wars and protectionism. One can't get away from it. So far, the US has been very vocal. You've seen the tariffs on steel, solar panels, washing machines. So I think it is a growing trend. I think what is perhaps more concerning is the more recent developments where it's been stock specific. So ZTE in China, they've backtracked on that, but were they to have blocked the supply of components, that would have materially hurt the business. And the same in the Russian case with the sanctions on Oleg Deripaska and how that then had implications for his companies. And the wider implications that we saw in terms of the aluminium price and other commodity producers having to think about their supply of aluminium, whether they can deal with Rusal and where it's coming from. So there were wider ramifications, and I think that took most people by surprise. And this then leads to the risk that who's next, what's next, and that's not predictable. Similarly, you've got the NAFTA negotiations, which are rumbling on. So I think there is a growing trend, and what does this do? It puts roadblocks in the way to global trade, which is the lifeblood of emerging markets. At the minute, we just have to hope for a relatively benign and sensible outcome, because it's not a zero-sum game. Ultimately, everybody suffers in a protectionist world.
What's the situation with regard to fund flows into emerging markets right now? 2017 had no volatility to speak of, and the performance was great. But in 2018, we've had volatility. Has that scared off some of your investors? Are they putting less money to work this year?
Fund flows have been more volatile this year, and that's understandable. I mean, January saw a continuation of 2017. It was an incredibly smooth run month on month in all markets, both developed and emerging. And then we hit February, and volatility crept back into the market, and fund flows have reflected that. However, I do think that's probably a symptom of faster money, those that have a longer term view on emerging markets and are invested in funds with a longer term horizon, 3 to 5 years, are not seeing huge flows.
Bryony, thank you so much for your time today.